Hey, it's Andy here. Just real quick before we get to the show, this is the second part of our two-part series with iCapital's CEO Lawrence Calcano. Now, we cover investing in the alternative investment space. And if you want to know what that is, please go back and listen to part one. In this section, or in this part, Mr. Calcano describes how they're looking at investing, how they make decisions on which funds and why, and we talk about why this matters for the markets and for the economy. Please enjoy. That's where you're generating your fees, but how do you get the fund managers to participate?
Sure. That's a great question, and a little chicken and the egg type of question.
Right.
But when you think about, as I said earlier, we're creating this sort of bridge or this connectivity between the general partners and the investors. We're really providing services to both of them. Most of what we've discussed to date have been more investor-oriented services, but from the GP's perspective, particularly as the number of pension funds and number of institutions, that number is not growing, and that number that group is already largely invested in this asset class. So the new frontier, the new opportunity is for general partners to access the high net worth marketplace, and most of them, are just not set up to do that because their entire infrastructure is set up to deal with the investors they've been working with for so many years, namely institutions. And so that means they take fewer investors, each of whom writes bigger tickets, right?
Yeah.
And so for them to move to attract high net worth capital, their infrastructure is not set up to take, thousands of tickets at $100,000, right?
Right.
And so for those GPs, we're providing a very important aggregation and operational service. And by the way, they also don't know where all these investors are sitting, because the high net worth marketplace is very distributed. So we provide a range of services and value to the general partners in helping them manage this asset class. And a number of the larger GPs, even those that have the capacity to hire people to deal with this, they've outsourced the management of this channel to iCapital. And so that's been, a very exciting development to be able to have both the general partners on one side and the very large distribution platforms, the largest banks, independent banks, RIAs, sort of relying on the infrastructure, operations, and technology that we provide. And so that's been a very important part of the model. Having said that, we also understand that a lot of the people in our network are fiduciaries, and therefore the pricing model, the way in which we get compensated, has to be crystal clear, transparent, and from their perspective, not in conflict. And so as a result, we don't take compensation from managers. Our compensation is to run the funds that the high net worth investors come into, and so we're getting paid to manage those funds. We're not also getting paid a distribution fee by a manager to sell funds on their behalf. In some cases, in hedge land, managers provide what's called a retrocession. In cases like that just gets passed on to our investors. And so having a model that's very transparent from a pricing and revenue standpoint is really critical. And frankly, it makes it a lot easier to operate.
Yeah, I totally understand that, and I think it gets rid of, and I can't say, but it just, from what I'm hearing, is it has to be crystal clear, otherwise people are not going to trust you, right? I mean, bottom line.
Yes.
And then trust is so critical in whether it's finance or fintech or name it. I mean, the two are the same, I guess, right now, without question.
Yeah.
We'll continue to go in that direction. But I just think it's fascinating because when you look at and I hate to take this into virtual currencies, I'm not making the comparison, but I'm saying from a platform standpoint, what's interesting is a lot of the ICOs, when I talk with investors like Alex Rampell from Andreessen Horowitz, he talks about, the ICO has a value because they're trying to encourage people to come onto this network or come onto this platform, and you're bootstrapping that platform via the value in the ICO. And so in this particular case, you're providing a service that's getting people onto the platform because they have a demand for access to investments that they just didn't have before, right? They didn't have access to that.
Exactly. We're in effect, people talk about technology most often as being disruptive, right? I see digital currency is viewed to be disruptive to the existing currency systems and marketplaces. We think of our technology, not necessarily as being disruptive as much as being enabling, right? And that there's a lot of people that want to invest in this asset class. There are a lot of general partners that want to have access to the high net worth marketplace. But having iCapital enabling that to happen is really where there's a lot of value. As I mentioned, people want to invest in these types of investments. General partners want to have access to these types of investors, and our technology stack enables that to happen. And I think, from the perspective of building a business, it's a lot easier to build a business when you're providing a solution that people are really interested in and want, as opposed to, believe me, we've spent several years having to evangelize, on the value of these types of investments, as I mentioned earlier when we talked about education. But, once people get comfortable with the asset class and the portfolio, and they go out and they seek it, if you looked at, it's funny, if you look at all of the CIOs across the large banks, across the largest independents or registered investment advisors, what you're seeing these days, and you see this on TV, you turn the TV on, you see, a lot of financial services firms, crossing out 60-40 and saying 50-30-20, right? The 20 being alternative investments. And so a lot of the CIOs in the marketplace are out really describing a asset allocation model that includes a pretty significant allocation to alternatives, 10 to 20% across the board, and many of the largest firms closer to the high end and the low end. And so, that's out there. But if you look at the portfolios that are serviced by those CIOs across the board, you'll find that most of those portfolios are well short of the alternative allocation that a CIO is making. Now, I'm not commenting on, what an allocation should be. Should it be 20% or 2%? I'm not making a comment on what it should be. I'm just commenting on the fact that there is an increasing, call from CIOs to allocate to this asset class. And so what we're seeing is, the ability to actually provide the pipes and infrastructure to really facilitate that to happen in a way that is, as we said, transparent, easy to use, and allows people to achieve their objectives, whether they're an investor or a general partner.
Right. So I guess the question that just jumps out at me is like, why didn't this happen like 5 years ago? Like, what has? I'm sure it's part of the evangelism that you've been doing, right? So that's good. So it's starting to produce results. But I mean, because you've seen so much. I mean, you were so heavily involved in the ramp up of the internet stocks in the 1990s, in the sense of seeing that, watching how that ecosystem developed. So you have a unique perspective on this, and I was just wondering, like, what your thoughts are.
Yeah, no, I definitely. I mean, when I was at Goldman running the tech group, I saw a lot of new models and a lot of new companies and disruptions and enabling, et cetera. And it was just a uniquely fascinating and amazing time, and honestly, it is a little inexplicable. I mean, the demand for these, types of investments, you've seen it at the big wirehouses. It's obviously a lot newer in the independent space, in part because they haven't really had the opportunity. And it's probably in all. I mean, if you look at financial services generally, you'll see almost every element, whether they're marketplaces, fixed income marketplaces, equity marketplaces, the delivery of financial services, tech is enabling all of this stuff to happen. Yeah. And this is the one area, and I think it's probably because, this area has been so governed by institutions, by pension funds, et cetera, that, a large institutional firm talking to a large GP, dealing with, hundreds of millions of dollars in a given given allocation. Technology was nice, but not really necessary. Mm-hmm. But as you pivot from the institutional marketplace to the high net worth marketplace, and that $500 million check becomes a $100,000 check times 1,000 investors, all of a sudden technology is no longer, a nice to have, it's a need to have. And so, I think it's clearly the desire exists for people to invest in this asset class. And again, technology is what's needed to make it happen.
Yeah, I think that's what's exciting about this time. I have to laugh because this is my first job in government, and I absolutely, people ask me like, why would you do that? I said, are you kidding me? This is better than Christmas in the sense of there's so many smart people out there doing so many interesting things right now because of financial technology, and we see it in a lot of the startup firms and people that we're talking to, trying to provide them a environment in which they can come to us and say, here's what we're trying to do, and we try to give them feedback on what regulations that they may have to think about. We created Lab CFTC to some extent to do that. In the UK, the FCA has been at the forefront of doing some really innovative things there on RegTech. So I think from my standpoint, is like watching this, what I get excited about, and I see companies like yours, it's tapping into a funding mechanism or a pocket of and a pool of investable capital that wasn't given access to this particular asset class before. And now, because that can be put out to, as you said, all of these 130,000 companies that are out there, it changes their funding model as well. And so perhaps we can have a more efficient capitalist system that gets money to people who are creating new jobs and things like that. So, sorry, I didn't mean to get long-winded on this, but
I think you're right. I'll tell you, I'll add to your comment, when you talk about the changes in the market. I mean, one of the changes that's quite interesting is, if you look at the number of tech IPOs, right? That mm-hmm. number has come down a lot recently. And, put the Spotify and some of the recent IPOs aside, the reality is over the last several years, the number of tech IPOs has been shrinking. And the time that it takes for a company to go public has been really, stretching out. And you see that these private companies, have stayed private for much, much longer and longer and larger, right? A lot of the unicorns, as they're called in the marketplace, could have gone public, given their size, billions of dollars ago, so to speak. But they've stayed private longer, and that's in effect created the need for, whether it's those employees that, need liquidity, that have been at a company for 7, 8, 10 years and haven't had liquidity. And in the tech companies, the option compensation the employees get is an important part of their compensation. And so, providing the liquidity for employees, providing liquidity for certain investors, providing capital for companies, all of that activity for these big companies is taking place in the private markets. And so, if you've wanted to invest in Spotify up till this point, you've only been able to do that through the private markets. Obviously they just went public. If you wanted to invest in Uber or Lyft or Airbnb, pick your favorite unicorn, you've only been able to do that through the private markets. So to my earlier point about finding growth, that's where the growth has been. And again, some of that's driven by the fact that, companies are staying private for a lot longer than was historically the case.
All right, just one last question before I let you go, because I've taken so much of your time. I really appreciate it. We got a little bit into the trends here. So give me your top 3, investing trends that you currently see, out for the next, whatever time frame, pick one. I think that's always very helpful for people to understand what you see in the future coming.
So, speaking through sort of the lens of the asset classes where we spend most of our time, I'd say there's a couple of areas that we just see a significant amount of interest in. One of which is in the credit space, in the high net worth investor base, and a lot of that has to do with the desire for yield, right? And particularly as the instruments we've been talking about are for the most part illiquid instruments. So being able to generate income throughout the life of an investment, is important to a lot of high net worth investors. And so it might not be that the entirety of the return is from the income. It could be that the return is a mix of quarterly or periodic payments plus some gain on the backside. But credit we see as a very interesting opportunity, and sort of related, real estate investments tend to also generate cash flow. And so cash flow oriented investments are definitely of interest right now. And then the second thing we've talked about, but is definitely still of interest, which is growth. People want to have a part of their portfolio that's allocated to growth. And in a lot of cases, what's really exciting about the private markets is, these companies, and I think this is, people think about liquidity as necessarily, not necessarily a good thing from an investor standpoint, but I'll tell you, the being private from a lot of companies' perspective is actually a very good thing, in a sense that they can do things that might be harder to do in the public markets, right? Whether that's getting rid of parts of their business or adding parts of their business, making changes, introducing new products where there might not be, certainty about how they'll scale, which is a risky thing in the public markets to not have visible view of earnings and profits. And so a lot of activities that occur while a company is private, really do increase value. In fact, we talked about diligence. So one thing I'd say is a lot of what we're looking at from a manager's perspective is how are they actually adding value? And the biggest thing, obviously, people have heard about leverage on companies, which to us is not a particularly important differentiator. What really is very interesting is while a company is being formed in the case of a younger company, or being held and managed in the case of maybe a larger company, is what's happening to the underlying revenues and earnings of a company. Are they growing? Are they doing the right things? And if they are, then one of the other measures of value is then hopefully if you bought something at 10 times, you might be able to sell it at 15 times because of the underlying improvement to the business. So you get margin improvement or multiple expansion when you go to sell it. And so, we're looking actively at what people are doing while they own a business during the whole period. And so, to the bigger question, the growth, the opportunity to invest in growth is a particularly important investment theme still. And I think people are always going to want to have some amount of growth investments in their portfolio.
All right, CEO of iCapital Network, Lawrence Calcano, thanks for coming on the show today. This has been delightful.
Excellent. Thanks, Andy. Appreciate the time.
Man, that was fun to speak with Lawrence. Fascinating to see what his company is doing and the technology they are using. Not everything can be or should be DLT or blockchain or ICOs or virtual currencies. Sorry. Okay, that's a wrap this week. We'll be back next week on our quest to learn about the markets we watch. I'm Andy Bush, CMIO for the CFTC. Thanks for listening. This has been CFTC Talks. But wait, we're not done yet. It's time for a disclaimer. The CFTC is providing this information as a public service, and it is neither a legal interpretation nor a statement of CFTC policy. Reference to any specific product, service, trademark, manufacturer, or service provider does not constitute an endorsement or recommendation by the CFTC. The CFTC is not liable to any consumer or any third party for any direct, indirect, incidental, consequential, special, or exemplary damages or lost profit related to the use of the information provided or referenced in this podcast. Selection of guests on the podcast does not imply an endorsement of any particular individual or entity. Many individuals and entities provide similar services to those of the guests. The views and opinions expressed by the guests in the podcast are their own and not specifically endorsed by the CFTC. Moreover, the information provided in this podcast should not be construed as investment advice. Consumers should rely on their own inquiries as to accuracy and relevance of the information incorporated or referenced in this podcast and assume the entire risk related to its use.
The CFTC is providing its interpretation of market trends solely to inform the public of a framework for projecting possible outcomes under different scenarios. If you have any questions concerning the meaning or application of a particular law or rule administered by the CFTC, please consult an attorney.